Hey guys, welcome back to the Independent Investor channel. My name is Ryan. Congratulations to all you guys that are starting your individual accounts. I applaud your efforts. And, sometimes it can be one of the scariest things. You may not understand all the reasons why, but the first thing that you could possibly do to help out your investment future is to just start the account, okay? A lot of times in human nature, we want to understand all the totality of everything we're getting involved with. And if we can't understand that, we sometimes get frustrated and we just don't do it. Or, you have to be personally recommended to something by a friend or a family. And, researching something like financials, which is really, really complex, and it's something that quite honestly, nobody understands everything about finances. It's one of those things that's an evolving art, and you've got to be flexible. You've got to be adaptable. You've got to be able to change to market conditions. And it makes it so difficult that a lot of beginning investors look at it and they just say, you know what, I can't do that. I'm not smart enough to do that, or it's just too complex. I would rather just not do it. Okay. And on the Independent Investor channel, I certainly try to, tear down some of those barriers for individual investors looking to have access to the market and just participate in the market. All right, we talk significantly about where your starting point is. Having that inner spark to start investing on your own. What account to start to get yourself on the right path, making sure that if you're running the Boston Marathon, that you're actually starting at the starting point for the Boston Marathon and you're not starting somewhere in Australia. All right, you got to start at the right place to end up where you want to be in your future. All right, so those are a lot of the things that we talk about. And even with that said, I still sit down with a lot of beginning investors and they look across at me, and I'm talking plain English, and they look back at me and they say, Ryan, you're speaking Chinese. Okay. And it's hard for me sometimes because I've been involved with investing since I was 14 years old. The first time I heard about the rule of 72 when I was 14, I was intrigued. I was intrigued insofar as I studied the rule and I tried to figure out why it works. And some of those things I didn't really understand why it worked, but it was certainly enough to, satisfy some of the intrigue or allow me to act on some of my intrigue about investing. And, a lot of that motivation when I first started investing, when I was around 18 years old, I bought my first set of mutual funds, entered into those accounts, and really had no business entering into a vehicle without properly preparing a buffer of cash. I had money, and so I invested every dollar I have. And there's a lot of advice online about, if you have the money and you're young, just throw it in the market. You're not going to hear any of that type of information on the Independent Investor channel, because what we always try to prepare for from a defensive posture is when and if the market is going to take a step back, whether or not you're prepared to either move on that market and maybe enter into the market with new funds, or you're prepared to just weather that storm through. Okay. And it isn't a question of when it's going to happen. It's a question of or if it's going to happen. It's a question of when it's going to happen, because they do inevitably happen. And that's usually a lot of the times when we lose a lot of investors that weren't properly prepared to enter in the market, and they're basically overexposed. All right, they've put too much into the market. And when we take a calculated approach here, we talk about strengthening that fundamental pillar of your investment portfolio. Once you get that account started and you're starting to use the cash account to fund that middle piece with either index funds or ETF funds that track that broader market, okay, that's going to give you the best chance to outpace the market and certainly do better on your own than you'll ever do with the financial institution or exposure using a third party. And that's just information that they just don't want you to have, quite frankly. Like if the financial institution could keep independent investors in the dark as much as they possibly could, I feel like that's what they would choose to do, all right? Because a lot of the dialogue that they propose to new investors is really just a lot of smoke and mirrors. They're not really telling you what the impact to your bottom line is going to be going forward, okay? And I think that's a real tragedy, and that's a lot of the reason why I put out the independent investor videos, with the intent of empowering one investor at a time. And what that means is they're able to take the information and say, you know what, I want to be on my own. I want to break away. I don't want to be part of this anymore. Or if you want to continue to hold on to the past, by all means do so. I know I've got some seasoned investors out there that are above the 50,000 or even up into the 6-figure, even 7-figure mark that maybe look back over their career and say, wow, I've aggressively saved, but I've saved in this investment vehicle that Ryan's talking about. Maybe I can set up an aggressive self-managed program, right, to seek out some higher return potential within those accounts. Maybe just buy it strictly with stock because you've got a good basis in either your 401k or your traditional investment brokerage investments. Maybe you want to start that tax protected if you're in your 30s, 40s, or even in your 50s, and you can start trading stock underneath of that Roth IRA umbrella, okay? So what I wanted to offer, I've got a lot of my investment audience is saying, okay, well, I'm starting to invest now. I'm on my own. And 2 things to help you. Number 1 is tools to investing. Understand and validate why it is that you invest. And so I've outlined just 3 tools to talk about. But keep in mind, don't ever hesitate to reach out for information. I've got a comment section at the bottom of my video, and I'm encouraging folks, if you're in on these videos now at the ground floor, I've only put out, a dozen or so videos. I'm on the ground floor, and if you have, if you're the one watching this at the ground floor, I highly would consider taking advantage of hitting me up right now, because I'll respond to every comment I get. Once the traffic starts to pick up and people really start to realize that the information I'm offering is content driven, and it's I'm putting out a lot of really credible information, then I'm going to be unable to respond directly to everybody, but I'll sure try. And if you can, forward me your questions, I will do my very best to answer them for you, okay? And, just know that there is help out there. But again, if you're doing it on your own, you're doing it the very best way possible, all right? You're not going to always understand it, all right? But just know that by doing it independently, you're doing it the right way for you and your family, okay? So the number 1 thing that I talk about is the rule of 72. The rule of 72 is really quite simple. If you take the interest rate that you can expect to achieve, let's say 8%, and divide it by 72, basically that's going to give you the number of years that a potential investment will double over time, okay? So the easiest example is a 10% proposed interest rate divided by 72 renders you around 7 years of doubling time, okay? So if you have $100,000 in the market at a proposed interest rate of 10%, you can be rest assured that by mathematical figures, that in 7.2 years you're going to have $200,000, and another 7.2 years from there you're going to have 400, then 800, then 1.6 million, and that's how that doubling calculation figures. And it's a really interesting tool to kind of break down investing from a fundamental perspective. Again, a lot of people, when they start, I've talked about this before, want to enter the market and they just want to become a millionaire, okay? Well, the rule of 72 can kind of help you break down the intermediary steps between starting with $1,000 and understanding with potential contributions or no contributions at all over a proposed interest rate over a particular year, how many years it will take for those dollars to double, right? So on doubling schedules from 1,000 to 2,000 to 4,000 to 8 and so on going forward. And you can kind of play with those numbers on a proposed interest rate. You can use any interest rate you want. If you want to be conservative, you can talk about a 6% interest rate, and that's going to affect the number of years that it takes to double right? And conversely, you can use, let's say, a 12% proposed interest rate, and then it's going to minimize the number of doubling years it takes for your money to double. So the first time I was introduced to the rule of 72, really, I just put it into my back pocket. I've used it my whole life to really understand kind of where I am in my life and what I can kind of understand on doubling cycles. You know, if you're a 20-year-old investor and you're watching this video, you know, you should perk up a little bit and kind of understand and look at maybe how many doubling cycles you'll have until you retire, which puts you into seven figures pretty easily, okay? The second thing is compounding interest, all right? As the years go by, as an investor, it's harder to see when you first start out the effects of compounding interest within those accounts. However, when you start in the right account and you start to get a sizable amount in those accounts as they get up to $10, $20, $25, $50,000, and those accounts really start to grow, you're really going to understand that year over year, any appreciation that you get on those accounts are gonna increase over time, and the amounts of capital appreciation that you're able to get, again, is within that right account, and you're able to keep that money tax sheltered. All the money goes back to you, and wealth preserved. All those dollars, again, go back to you, okay? Now, the last thing I wrote on here is dividend reinvestment. Guys, if you're with a financial institution and you opt for dividend reinvestment, if you own stock in your portfolio, they're charging you for this function, all right? And I've talked about this before. This is just a setting in your account. It'll take you all of a minute to go in and set all of your stocks to dividend reinvestment, all right? Now, if you're a passive investor and you have ETFs and index funds within your base account, all right, only index funds are eligible to dividend reinvest. ETFs are going to pay you cash, okay? And that's just the start of the psychology behind investing, is to take your dollars, and if you pay yourself first, to put it into a vehicle to become a money machine, all right? I can use the money machine analogy, or I can use the, planting a seed analogy. You're not really going to understand the effects of these bottom two tools until those trees really start to grow and bear fruit, all right? So by planting the right seed now allows those dollars to grow properly over time, okay? So these are just three tools that I threw up here to kind of put in your tool bag to kind of validate why it is that we invest. Again, none of these tools really mean anything unless you're abiding by, my avoiding mistakes and getting into the right account and making sure that by utilizing these tools outside your account to affect what's going on within your account, they're not going to have as sizable of an impact unless you're investing in a vehicle that's allowing your money to return maximum value for you as an independent investor, okay? Look, guys, I hope you enjoyed the video. Please tune in for follow-on videos. If you hit the subscribe button at the bottom, you'll be notified of follow-on videos. Again, I'm opening the door out for all my new investors, all the folks that are with me. This is ground building for me. I'm in the fundamental stages of building my independent investor channel, and I'm going to be a lot more accessible now. So throw some statistics my way. Throw me your age, throw me your income, kind of give me some ideas about what your investment goals are, and I can do up a financial response within a couple minutes. It's actually quite simple, and I think it's to your benefit. All the information that we offer on the Independent Investor channel is free of charge, but do not underestimate the power of the information for sure, because this, again, is information that I think the financial institution would just as soon keep secret from everybody and keep most everybody in the dark. And my intention through empowering independent investors is to shed some light on some of the truth within the industry. Listen, I hope you've enjoyed the video. Hit the thumbs up button. Share the video with anybody who you think might benefit from the information. Look forward to being with you on follow-on videos, and good luck in your financial future.